Hey there, welcome back to my channel, it's me the Mind Injector. In this video we are diving deep into a puzzle that's been on everyone's minds, the recent stock market turmoil. There's been a lot of talk about inflation, recession risks and even rising treasury yields. But here's the twist, the real culprit behind the falling stocks might just be rate cuts. Before we dive into this video guys, I've got some exciting news for you. I want to introduce you to Moomoo Financial. If you open a brokerage account with Moomoo and deposit at least $1 using the link in the description, you'll get a chance to draw a free stock worth up to $2,000. But that's not all. If you make a net deposit of $100 or more, you'll receive not just one, but 5 free stocks worth up to $2,000 each, plus free premium courses to help you sharpen your investing skills. And if you're really serious about investing, you can deposit $1,000 or more and get a whopping 15 free stocks, bringing your potential earnings to a staggering $30,000. So, sign up for a Moomoo brokerage account using the link in the description and start earning those free stocks. Now, let's jump into the main content of this video. That's right, rate cuts. But wait, didn't we see the Federal Reserve raising interest rates recently? Well, yes. But here's the thing. We believe the Fed is done with its rate hiking spree. The federal funds rate is at 5.25%, the highest since 2007, and inflation is at 3.2%. Now, if we do some math, that means the federal funds rate is around 200 basis points above the inflation rate. Wall Street seems to agree with this too. Odds for another rate hike have been consistently low for the past few weeks, around 10% for September and basically zero for after September. So, if the Fed isn't likely to raise rates, what's causing this market turmoil? Here's the twist. Rate cuts are likely on the horizon. It's becoming clearer that the economy isn't on the edge of collapse. Recent data shows consumers are still spending, jobs are plenty, and housing and stock markets are recovering. So, brace yourselves, rate cuts are coming. But how will these rate cuts unfold? The Fed wants to return the Fed funds rate to a neutral level once inflation is under control. Best estimates for the neutral rate are between 2% and 3%. So, brace yourselves for rate cuts of 200 to 300 basis points over time. But here's the twist. The stronger the economy, the longer it will take to control inflation. And that means slower rate cuts. And that's where things change for the market. The market was initially pricing in 6 rate cuts for 2024, but now it's looking at just 4. The slower rate cuts mean higher treasury yields in the short term. And when yields spike, stocks drop. That's the crux of the issue here. So, we are in an ugly dynamic right now. But don't worry, this isn't a lasting scenario. The belief that a strong economy will lead to sticky inflation doesn't hold up. The CPI, which gauges consumer prices, is heavily influenced by shelter costs. But guess what? Shelter CPI is set to crash over the next year, mainly due to lagging indicators and real-time data. Commodity prices might have risen a bit, but they are not resurging in a way that will keep inflation high. Plus, the post-pandemic spending boom was driven by low interest rates and excess savings. But now rates are high, and those extra savings have dwindled. When we put it all together, we are looking at inflation rates of around 2% to 3%, not the 3% to 4% that's been causing worry. This means we are in for a stabilizing economy with falling inflation, a combo that will allow for some pretty swift Fed rate cuts. Here's the silver lining. Every time the Fed has cut rates without a recession looming, stocks have soared. It happened in the 80s, 90s, and 2010s. So, considering the upcoming rate cuts and the strong economic foundation, we're betting on a repeat performance. We're confident that the dynamic we've seen before will repeat itself in 2024 and 2025. As the Fed cuts rates and the economy avoids a recession, stocks are likely to soar. So, despite the current market turmoil, there's a bright future ahead for investors. This is it for this video guys, thanks for watching and please make sure to subscribe, like and leave a comment down below.